Good day, fellow investors. Is this a fundamental stock market crash or just short-term panic? We're going to go through 6 points to illustrate what's going on and what can we expect going forward from the market, the VIX, the worries, the bubble bursting, and the expected Fed's intervention to save us all that will lead into an outlook also based on fundamentals. Let's immediately start with the VIX, and it has jumped to 65.73, and that was the level also reached 4 years ago during the peak of the pandemic panic, and also similar levels in 2009. Now we'll see whether this will persist with ups and downs, but let's look at the market and try to explain what's going on and put things into a longer term perspective, which is usually what we do on this channel. First and foremost, despite whatever happened the last few days, the market is still up 77% over the last 5 years. That's something in whatever environment. Of course, if you look at the last 6 months, it's still up 4%, and perhaps something that people tend to overlook when they look at the data and the headlines and the news and whatever is that from October 2023 to July 12th, the market was up a staggering 36%. When something goes up like that, 36% from already elevated levels, you know that something will happen at some point in time, and we have now seen this 3-day correction and panic and change in momentum that just reflects what has happened in the last 9 months, and the market is still significantly up. However, what I want to discuss here, and that's my theory, that today nobody cares about fundamentals because stock go either up or down. And if you just look at the last 5 years, up, down, up, down, up, and now we have this panic, and we will see where will this down stop. The first indication of the rebound have already been this morning if you're watching this on Tuesday, and Japan already bounced back, so from down 12% now down just 5%, and likely also the US market will bounce back, but that is just day-to-day trading, bouncing back, chasing that momentum, traders moving the market. The key is where will the fundamentals going long term and what can we expect long term, and for that we must discuss the worries that are now plaguing the market, that have been there since 2011, but nobody cared. And I have found this cute summary on Bloomberg. So we are now worrying about a hard landing, about the Fed being too late in cutting rates, and the jobless claims are the highest since 2021 when the market was much lower, and now they are expecting bad news going forward. Earnings season is not as expected. AI is, guess what, not delivering on the promising and the changing the way we wipe our behinds. So that's something. And perhaps the most important news that may be overlooked in this market is the following. Berkshire slashed its Apple stake by 50%, and Warren Buffett's cash pile is now at $276 billion. Always look at what the old man is doing, never at what he is saying. That's something we have learned over the last few years. And then nasty surprises are nothing new, but here and whenever we talk about the markets that are detached from fundamentals, you have to focus on a tipping point. It's always it goes until it doesn't, and then when that tipping point is reached, panic, as I said, detached from fundamentals, and that's enough to switch the momentum in the markets. Now we have a slight uptick in jobless claims, which some say also leads to a recession, as the ISM manufacturing employment is hitting, let's say, a recession indicator. We will see whether there will be a recession, whether the Fed will invent something, but That's normal also. Recessions should be normal, especially after this exuberance that we have had in the last years, where, if you haven't forgotten, you were sitting on your couch and you were receiving money directly to spend. And the latest rise in unemployment implies a US recession underway. Well, if it happens, it happens, and now everyone is panicking like there should be no recessions. Why not? Anyway, the cut expectations for the Fed are now from 1 to 6, and we'll see if the Fed will cut 6 times in the next few months to prevent a recession, to prevent the stock market crashing, even if it crashed where it was a few months ago. So it's still close to all-time highs, so nothing there. But we also need to discuss something that we discussed 4 weeks ago when many said that I am the idiot, but I looked at the fundamentals and everything, and I told you it is a clear bubble. And now that bubble is maybe bursting, which will have again implications also on the economy, spending, investing, and everything that is related to that. And the same story happened in the 2000s. Some say that the bursting of the dot-com bubble led to the recession 2001-2002, and maybe that will happen again now. We have seen clear bubbles there on huge expectations which cannot be met in the same timing and the same profitability as some people expected. Some bubbles have been deflating a little bit more slower, but it is clear that those expectations are never met, and this usually 36% in 9 months sets huge expectations that of course nobody can meet. And plus, when stocks go up, as I told you, detached from fundamentals, there is so much betting going on and so much betting on the trend not to miss out that also this happens. It is insane to me, but the daily semiconductors bull 3x shares, which delivers triple the daily moves of the NYSE semiconductor index, took in a record 2.8 billion inflows in July. So 2.8 billion were invested on betting that it will go higher, higher and higher forever, and then since then it fell 60%. So congratulations on those betting on such a daily tracker that's actually built to go to zero if you read those prospectuses. Anyway, the market is going down, and now we are all expecting the Fed's divine intervention, cutting rates, maybe printing some money to fill your pockets again and keep the party going. We'll see whether they will cut. Some of them said they will not rush to a cut, so probably waiting till September, but then starting with the cuts, depending also on inflation. And we have discussed this many times over. Given the public debt, and this was also something that was unsustainable at those interest rates, and now perhaps the Fed can cut rates, save a little bit of the government, but the government will lose on less economic activity, unemployment, etc., etc. So at some point, the first scenario is the Fed cuts, all right, everyone happy, the market jumps back and keeps going up, so everyone feels good, and Sven remains the idiot. Unfortunately, there is also the second scenario. Fed cuts rates, it leads to inflation. It is hard to borrow for the US because the fundamentals, as we'll see later, are unsustainable, and therefore we have a crisis situation where what the Fed has done up till now doesn't work anymore. We see inflation in the Eurozone being a little bit higher than expected, still not going below 2, still there, still in the minds of people, and it can jump higher because, as I said, it's all about tipping points and how people move. US inflation, they now expect it lower, but it's still 2.6 for projected for this year, and then we'll see whether it will go lower or no. Surprises are always around the corner, as we have seen over the last few days. There are trends that are deflating a little bit, subsidies, what works, what doesn't work. So the world changes, but might not change as fast as you expected. And when it comes to this, I hope that the Fed's, ECB and everything will work over time, and that we continue to live in a good environment, that we don't have panics, crashes. 2009-10 was very bad for a lot of people, so I hope that doesn't repeat itself. But my fear is that one day the Feds and the deficits and spending like there is no tomorrow, like we can just print it all, we can just engineer it in a monetary way, that someday, I know, because it's historically proven, doesn't work anymore, and then you have huge inflation, stagflation, and then you restart from some bottom somewhere, which usually looks very, very ugly. I hope it doesn't happen now, it doesn't happen tomorrow. I'm not against some volatility for a year or two, but when it comes to the outlook, we have to understand one thing. The markets just went up. Financial assets are in a bubble because of what we have lived through the last 15 years with the money printing and zero interest rates. And that means that the fundamentals are insane in a great economy. Earnings are at the max, and the P ratio is still 27. If you look deeper, the dividend yield even after this crash is 1.4%, which is absolutely nothing. You will not get rich on it. And people say buybacks, 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 but buybacks are worthless if the companies are buying overpriced securities, as most of those are. And again, look at what the old man does, not what the old man says. Because this is clearly unsustainable. We have discussed this over and over. You cannot borrow 28% of your spending forever. And these are all projections that look very ugly, but these projections are actually made on great numbers. There will be GDP growth forever, 2%. There will be no recessions, no nothing. Inflation will go down. We can print again money. We can lower rates. What if inflation goes up? We have to keep rates higher. What if there is no GDP growth? Then these numbers that look terrible now look even worse. And that is something that we will have to live through over the next decades and try to solve. So I'm telling you, there are no fundamentals, therefore we have to expect increased volatility in the future, panics, recoveries, rebounds, this or that. It's just a question of timing. I pray there is no huge crisis. I pray we somehow work it out over time. But I'm telling you, this is not sustainable, and this spending like there is no tomorrow led to the greatest bull market ever. This is more than a 7x for the market over the last 16 years. That's insane. And at some point it will stop. We have discussed that the fundamentals are leading to zero returns for the next decade or two. And that's usually what happens after the great bull market of all time. It might be even 3 decades of zero returns, because the fundamentals have to be mended, and that takes time. At some point you have to pay the price of this exuberance. You cannot have a free lunch in economy. When will that price be paid? I don't know. It's impossible to know or predict. As value investors, the only thing we can do is hold value, and that's why you are watching these videos. Your house, your mortgage, 40-year mortgage fixed at 2-3%, that's now free money that we used to talk, other value investments, etc., etc. That's the only thing we can do, and stay away from these bubbles. I've been telling this since ever, so if you stayed away, yes, we missed on some upside, but we'll also miss on a lot of downside. Thanks for watching, subscribe for more, and I'll see you in the next video.